Here's Hopi Mountain Capital. They do private equity secondaries. It's a limited partnership. The management fee is 1.4% on committed capital, reduced by 10% per year after the 5-year investment period. The carry is 15%, subject to an 8% preferred and a 10% catch up to 12%, I think it is, or carry up to 12% preference with full GP catch-ups at each tier. And they have a little paragraph describing it. One unique advantage is that we have the ability to recycle capital returned quickly into new transactions, which is possible with secondary investments, thus aiming to boost the investor multiple on investor capital without charging additional fees, etc.
Well, you have to be chat GDP to understand the economics. And then on the last one, it's a very interesting niche strategies where returns are very high there, but they're very highly illiquid. So I'd want to know, how can they recycle capital in a highly illiquid market?
Right. I'm guessing that their secondaries, they're both buying and selling them, and they're a market maker in that space. It is an illiquid market, but I'm guessing that's
opportunity.
how. But I don't know.
This week, like $1 trillion of secondaries need to be moved around up.
Right. Yeah, for sure. So I think that one challenge I found is that you might spend so much time designing something that's really good for investors, but because it has 4 parts, maybe some investors are like, it's just, I can't even get my arms around that. And it's done with intent to make it really good for investors. But sometimes if investors don't understand it immediately. Yes, Sahil, and then Sean.
And then, it does, from what I'm seeing here, it looks like it's a little bit more favorable than your average terms because you're looking at like a 20% carry. But it's also, I really don't like when we have these extra tiered waterfalls. I know that it's very common, but it just makes it so much harder for the investor to calculate how much they're actually supposed to be owed. It's at a certain point, there's a question of the investor asking, okay, well, is this intentionally opaque? Is their personality such that they don't actually want me to know what's going on here?
Yeah, interesting. I think one thing I found related to this is that a large percentage of high net worth investors and a very large percentage of doctors that invest do not know what a catch-up clause means. Like, oh, there's a catch-up. It's like, okay, well, then they're going to match all the preferred return you have, and then you split beyond there. And that term that there's a full catch-up is just a couple of words that dramatically changes the return for the investor, to Sahil's point. And it's like one of the most tricky little words that a lot of investors don't catch.